All right, let's just dive right into this. Welcome to today's explainer on the income statement. You'll also hear it called the profit and loss statement, or just the P&L. Basically, this document tracks the absolute lifeblood of any company, showing exactly how money flows in and, just as importantly, how it flows out. To get us there, we're going to break this down into 4 quick steps. We'll start with the big picture, then move into the building blocks. After that, we'll look at a real-world example with the XYZ story, and finally, we'll wrap up with why it matters. So, let's get to it. All right, part 1, the big picture. Before we get lost in the nitty-gritty numbers, we really need to nail down what this critical financial document is actually doing. And the distinction here is absolutely crucial. People mix up the income statement with the balance sheet all the time, but they do completely different things. Think of a balance sheet as a financial snapshot of a business at one specific moment in time, literally like taking a photograph. But the income statement, that tracks the financial flow over a period of time. It's more like a movie, dynamically showing how cash is moving in and out over weeks, months, or even years. And you know what? That entire financial movie really just boils down to one surprisingly simple formula. Net income equals revenue minus expenses. That's it. That is the fundamental math used to figure out if a company is actually turning a profit or if it's bleeding money and taking a loss. It's just the money coming in minus the money going out. Okay, let's move right along to section 2 and see how this actually builds. Time to look at the building blocks. So the thing to remember is that our simple little formula actually has a few layers to it. We start right at the top with revenue. This is your top line sales, right? The total money earned before you deduct a single dime. This could be operating revenue from your main business or even non-operating revenue, like interest from investments. Next up, we have expenses. These are all the costs that get subtracted from your revenue. And finally, you're left with net income, which is your true bottom line. But let's take a closer look at how those expenses are actually categorized. This brings us to arguably the biggest piece of financial jargon you're gonna encounter, COGS, or cost of goods sold. Now, all this really means is the direct, unavoidable costs of actually producing your goods or services. We're talking raw materials, factory wages. If you're building bicycles, this is the cost of the metal, the rubber, and the hands that put it together on the assembly line. And when you subtract COGS from your total revenue, you get what we call your gross profit. But obviously, a business isn't just building the product, right? You've got to keep the lights on. That's where our next deductions come in. First, we have operating expenses. These are the indirect costs you need just to run the business day to day. So think rent for the office, salaries for your marketing team, utilities, advertising, that sort of thing. When you deduct these, you're left with your operating profit, also known as EBIT. After that, we have other expenses. These are non-operational hits, like taxes and loan interest, which just take another chip out of that final number. All right, enough theory, let's look at reality and put these pieces together. Moving to section 3, the XYZ story. So here we have a simplified 2024 P&L statement for XYZ Manufacturing. And honestly, this is basically a battle of shrinking money. XYZ starts off incredibly strong with a massive $750,000 in revenue. But then the attacks begin. We subtract $400,000 for cost of goods sold, which leaves a gross profit of $350,000. Next, rent and salaries eat up another $225,000, bringing their EBIT down to $125,000. And finally, they take a $50,000 hit in combined interest and taxes. To really put that into perspective, out of every single dollar XYZ brought in, where did it actually go? Well, COGS ate up a whopping 53%. Operating expenses swallowed another 30%, and interest and taxes claimed 7%. So that massive revenue pot was just sliced up mercilessly, leaving them with only a tiny 10% sliver at the very end. But hey, here is the victorious part. That 10%? It equals $75,000. That is the surviving bottom line net income. Out of $750,000 flowing into this business, this $75,000 is the true metric of success. Because despite all those massive expenses, they crossed the finish line and ended the year profitably. So we've done the math, we've seen the flow, but why do we go through all this trouble? Let's zoom back out for our final section, section 4, why it matters. Well, it turns out a lot of people care deeply about these numbers. Investors use them to evaluate long-term growth potential before they risk a single cent of their capital. Banks and lenders, they review them to assess stability, to see if you even qualify for a loan. Business owners rely on them to control costs and set pricing. And of course, governments need them to calculate taxes. Basically, everyone has a huge stake in this flow of money.
Now, I kind of want to turn this over to you for a second. If you were a bank, would you lend XYZ money based on this math? Think about it. Sure, they have $750,000 in revenue, and they're technically profitable, walking away with $75,000 at the bottom line. But their direct costs alone are over 50%. Applying what we just went through in this explainer, you now actually have the structural tools to judge their financial stability for yourself.
And that brings us to our final thought for today. Because the concepts on an income statement aren't just for massive corporations. If you took this exact same formula, net income equals revenue minus expenses, and applied it to your own personal finances this month, what would your bottom line reveal? Are you operating at a profit or a loss? Thank you so much for joining me on this explainer, and I really hope you look at the flow of money in a whole new light.